going to talk about why I believe, in my professional opinion, the concept of passive income, specifically as it relates to real estate, is somewhat of a myth. I'm going to explain this in two parts. First, I'm going to explain that based on the definition of passive income, which I will define, whatever cash flow you derive from real estate will not fit that criteria, that definition. Thus, it's better just to think of it as cash flow and not passive income, because if you want to think of it as passive income, you'll be disappointed. Secondly, what I'll also do is show you that even if you are able to derive cash flow, and if you want to call it passive income, which once again, I'm telling you, you shouldn't, but even if you do, the cash flow you will derive will not make you rich. You know, which is a concept or an idea which is pushed by a lot of people who also propagate the idea of passive income as it relates to real estate, that if you just make passive income and keep on building on your real estate empire, you will become rich just based on the cash flow, which is patently false. So in summary, first I'm going to tell you why the definition of passive income does not apply to the cash flow you get from real estate investing. And then I'm going to describe why even if you do call that cash flow passive income, you will not become rich from passive income. Passive income in most cases will only help you break even, maybe if you're lucky, make you a little bit of a negligible profit. I just want to preface one important thing. This video is only about passive income as it relates to real estate. So I'm not an expert in stocks. I do invest in stocks, but I'm not the foremost expert. I consider myself an expert in real estate because I'm a real estate agent and I've studied the field for a while. So in stocks, I don't feel comfortable saying that you can't earn a decent wage through passive income through investing in stocks. I think you can. But I might be wrong. Once again, I'm not an expert. However, in real estate, it's far more different than stocks. And I've made several videos on this topic. Feel free to check them out. Okay, but before we get into that, please, as always, subscribe, comment, rate, and review. You can find my contact information in the description. Right now, I'm working with many buyers, but you know, if you have any questions, concerns, or just generally want to chat it up, feel free to get in touch with me. I don't mind talking to people about anything. I'll talk about basketball. I don't care. Okay, first things first, why do I think passive income is a myth? In the sense that the definition does not really apply to any cash flow derived from real estate. Okay, let us first define passive income. Passive income is generally defined as the following. It is income earned from a business venture, whether it be a limited partnership, real estate, stocks, or other business enterprises, that the participant, that means the recipient of the income, is not actively involved in it. And around that definitions, there are further suggestions that not only are you not actively involved, but whatever limited involvement you have in it, whatever passive involvement you have in it, it takes up a little bandwidth, meaning it's not a lot of work whatsoever. Off the bat, I think most people who even believe in the definition of passive income would also suggest that the second part of the definition I just stated is ridiculous, which I think it is. So why is this definition a faulty one? And why does it not apply to real estate? When people talk about passive income from real estate, they refer to the cash flow you derive from it. And typically, the majority of the cash flow you would derive from real estate has to do with the rental income. So for our sake, we can use the words rental income, cash flow, and passive income as somewhat interchangeable. And when we're talking about rental income as cash flow and therein as passive income, the reason the recipient of the cash flow is not a passive participant in this business enterprise is because we're assuming that the reason this person, the participant, is receiving this rental income is the landlord. And when you're the landlord of a tenant who's providing you with rental income, you're the owner of that property. You're legally tethered to the business enterprise, in which in this case is the investment. So as we've agreed, when you're the landlord of a property that you're renting out, you're the owner of that property. And since you're the owner of that property, your name is on the title. The title is the legal instrument that is proof of ownership. When you purchase a property or sell a property, the transfer of ownership occurs only when the name on the title changes. Think of it as a owner's permit. By definition, you're not a passive participant in a investment. Your name is on the title, meaning if there is a fire on the property, or if the property floods, or even in the good side of that situation, you sell the property appreciates a lot, you're either held liable for the losses or held liable for the gains. So this is in a scenario where your name is on the property. So you may ask, well, what if I and another individual, we partner up, we pool our resources together, and we buy a property together? But you're still not passive then either, because instead of just your name on the property, now there are two people who are held liable. Even if everything goes smoothly with your property, there's no reason to claim insurance on anything. There's no break-ins. The property does not depreciate significantly. Even if everything is good, you're still actively involved in reaping the rewards because you are the owner along with your partner. You can't passively be involved with an investment or a business where you are the CEO, for a lack of a better term. You're very much so actively involved in that scenario. So you may say, well, what if I create a corporation, a shell corporation of sorts? So my name is not on the title, my corporation owns the property. You are a little bit further removed, I'm not gonna lie, but I can still argue that you're not passively involved because you are, in theory, the CEO of your corporation, and the property you own is an asset of your corporation. Sure, in this example, you don't have shareholders you have to answer to, executives you have to answer to, but the health of your business still determines on the management of this asset which your business owns, which is this property, this house or land, and you are the CEO of that corporation. You're very much so still actively involved. When you create a corporation for the sake of ownership of real estate, it's not to make your job easier necessarily, it's to give you further advantages in terms of how much profit you can derive and how much you'll be taxed. However, it's by no means a tool to make your involvement in the investment easier. You're still as active as ever. For this reason, I argue you cannot be a passive participant. Whether it's you and your friend, a corporation, or any combinations thereof, you're still very much so an active participant in this business and investment venture. Let's get to part two. And as I said, in part two, I'm going to describe how hard it is to actually make a substantial profit from passive income, which, as I said, is not passive whatsoever. So for this part, I'm going to assume a couple of factors. I'm going to assume that you're going to put 10 to 15% down, meaning you don't have a ridiculous amount of cash at hand to put down 60%. So when you only put down 10 to 15%, you obviously have to loan out the remainder. And the less you put down, the more your loan is and the more interest you have to pay and principal you have to pay. And this isn't just to make my point. This is what I deal with mostly with a lot of first-time home investors. They can only put down 10 to 20% in my experience. Now, obviously, there are a lot of wealthy people who are investing for the first time and they've saved a lot. They can put down 20 to 30% and even more. I just haven't dealt with those people in my professional life. So let's go with the assumption of the down payment of 15% of the purchase price. And we'll say, for the sake of easy analysis, let's say the purchase price is $500,000. Further, let's assume that we're talking about a large city such as the city I work at, which is Toronto, but other equivalent cities may work. New York, Vancouver, Los Angeles, Chicago, so on and so forth. The reason we're assuming a larger city and a hotter market is because $500,000 can get you substantially less in these types of markets than it can get you in Cleveland, Ohio, Montana, or Winnipeg. Furthermore, let us assume an interest rate of 3%. We'll put the life of loan at 30 years and we'll make it 12 payments a year, so a payment a month. In summary, having assumed the down payment of 15%, the purchase price of $500,000, in a large city such as Toronto, and 12 payments a year for 30 years and interest rate of 3%. I might have said that twice. Monthly payment, principal plus interest, is about $1,186 a month. Furthermore, let us assume annual taxes of $2,500. And obviously you need insurance on the structure and other types of insurance such as title insurance, fire insurance, so on and so forth. So for the sake of easiness, however, let's put all the insurances into one total amount, and let's say we put it at $390. Let us assume, for the sake of easiness, zero cost for the upkeep of the property. Obviously, we also have to pay condominium fees and condo fees at $450. Furthermore, let us put the utilities at a very fair $280. So you got your annual taxes and your annual insurance costs, plus your monthly condominium fees and your monthly utility fees, and then altogether, it brings our amount to $967. $967 is a sum total of the monthly expenses beside the first figure I gave you, which was principal plus interest. Now, putting these two figures together, you have your total cost in this very, perfect example, which comes about $2,153. This is your total monthly cost: principal, interest, insurance, taxes, utilities, everything. Now, that's your cost, $2,153. How much are you gonna rent out this property for? Like I said, it's a $500,000 property. You can't just rent it out at $3,000, $4,000. You have to pick a price that the market deems as a fair price. If you price it too low, you're gonna be at a deficit. If you price it too high, your rental property is gonna be on the market looking for tenants for about 50 to 70 to 100 days. And where I work, a $500,000 property in Toronto, in the city, in terms of condos, typically ranges from $2,150 to $2,400. And I'm kind of pushing it at $2,400. But whatever figure we choose for our rent price between $2,150 to $2,400, you see, you're either losing money or barely making a profit. So people who push the idea of passive income as in making you rich, no. What makes you rich is owning real estate and waiting for it to appreciate and selling it and getting the proceeds from sale. The return on investment is the proceeds from sale. The return of investment, which is rental income, well, sure, if you could put a lot of money down as a down payment, can be substantial, but a lot of investors are not in that position to put down 30+%. And anyways, that's the video, guys. Hopefully I made my argument clearly. If you disagree, please let me know why. And yes, please subscribe, comment, rate, and review. I have many more videos coming out. And yes, stay safe. Thank you very much.